If you are a freelancer or someone who's been exploring the idea of having a side hustle and you want to know more about how to set up your business, this video might be for you. I'm going to be talking about different types of corporate structure and focusing on two main types: sole proprietorship and LLCs. For context, I run two types of business. I have a sole proprietorship when I'm working as a consultant, and I co-own an LLC. These were the best types of structure for each of those businesses, and I'm going to be talking more about why as we go. Cool. So there are four main types of business structure. You can be a sole proprietor, you can have a partnership, a corporation, and a limited liability company, which is an LLC. I believe that if you're starting right now, the best types of structure for you are either going to be a sole proprietorship or an LLC because of the simplicity that it is to set it up and the flexibility that they offer you. The sole proprietorship on the simplicity side, the limited liability company, and the flexibility side of things. So let's start with the sole proprietorship. A sole proprietorship is a business that is owned and operated by a single individual. It is the simplest and oldest type of business structure and is extremely easy to operate, to set up and operate. Pretty much no cost, and in the great majority of cases, there's no paperwork that you need to file to start your sole proprietorship. This was something that in the beginning, a few years ago, it would bother me. I would ask my CPA and people that I was working with, what do I need to sign? What is the document that I have to prove that I am a sole proprietor, that I'm running a business, that I'm making a side income? Because usually when you have other types of business like an LLC, you would have to go in the IRS website, file for an FEIN, which is a federal employer identification number. You'd have to set up and have a certificate with your state. You have to have an operating agreement. There's paperwork. There's something that proves that you are a business. With a sole proprietorship, if you are a freelancer, by definition, you are already a sole proprietorship. There's nothing really that you need to do in the great majority of cases. There are some cases where you need a license, you need a DBA, a doing business as, but that's something that you don't have to worry about right now. The profits and losses of a sole proprietor are reported on the owner's personal income tax return. If you are not familiar with the concept of profit and losses, a P&L or a profit and loss statement is a financial document that summarizes the revenues, expenses, and the net result of a business. So pretty much is your revenues minus all the expenses that you incur to run your business, and the result of this is going to be your net income or your net loss. Whatever you have at the end of the fiscal year will be reported in your normal personal income tax return, which is the Form 1040, which means that you don't have to file a separate tax return for your entity. You don't have to hire a CPA and pay additional fees to have that at the end of the year, which I believe it's a benefit. The downside of a sole proprietorship is that you as a sole proprietor and your business are legally one. There's no separation between you and your business. You are your business, which means that you have complete control, but you also bear unlimited personal liability. If your business incurs debt, or if you are if you are part of a lawsuit, your personal assets like your car and your house and whatever you have on the bank account might be at risk. You might be thinking, why would anyone choose a sole proprietorship as a structure if you have this unlimited personal liability? And the answer depends on two things. First is what type of business you're running and how you're operating your business. And second, what's your risk tolerance? For example, in my consulting work, I am comfortable with the level of risk that I am facing, and I appreciate the simplicity of a sole proprietorship structure. I appreciate not having to have additional documents, not having to pay someone to file the taxes separately, and maintain the paperwork. This is why I believe that if you're just starting by yourself, you should start as a sole proprietor. Again, because of the simplicity, because you can just hit the ground running, and mainly because I believe that when you're starting something, your main job is not to set up the most robust business structure and worry about an FEIN and worrying about an operating agreement. You need to prove your concept, and you need to make sure that this idea that you have, this freelance gig that you started, it's actually profitable and actually will take you somewhere. Because of that, I wouldn't waste time structuring a business unless you really need to, unless you really need the personal liability. And I would focus the first 6 months, a year into making that a business, operate as a sole proprietor. The important thing here and the tip is that even though a sole proprietorship is a simple structure, you should still maintain some level of organization. Open a separate bank account, start an Excel spreadsheet, or open a QuickBooks account, an accounting software, and keep your numbers separate. So all the money that you make, all the revenue, because you probably will have to invoice someone, and all the expenses that you incur running this business, keep that separate. A separate credit card, a separate bank account, but this can all be done under your Social Security. You can go to the bank right now, open a bank account under your Social Security. You don't need a business bank account, and operate. Let's see why and which cases you wouldn't go for a sole proprietorship and you would open the second option, in my opinion, which is a limited liability company. I'm gonna quickly go into partnership and corporation structures because there are elements of a partnership and corporation that are important for us to understand before we understand what an LLC is. So next would be a partnership. A partnership is a simple structure similar to what a sole proprietorship would be, but when you have partners, when you're not doing this by yourself and you have either one more or more than one person operating with you. There are two main types of partnership. You can have a general partnership and a limited partnership. A general partnership, it's a structure where all partners share equal management responsibility and personal liability. So that same personal liability that you would have in a sole proprietorship, you also have in a general partnership. They can also come after you. You don't have that separation between the business and yourself. You can have a limited partnership, which includes both general and limited partners, with limited partners having the limited liability only up to the amount that they invested in the business. So in this case, you have a structure where someone will bear all the liability and other people would be limited partners, and then in this case, they would have limited liability and the protection. Cases where this happens are in funds, for example, like a real estate fund. Let's say that I want to start a real estate fund. I want to buy a few houses around here. I want to fix them up and sell it for a profit. In that case, I could open a partnership. I would be the general partner managing this, and whoever decides to invest in me and give me money to buy the houses would be limited partners. If the business didn't work out and I actually lost all the money, the limited partners would lose whatever they gave me. They would lose up to the amount that they invested, whereas I, as a general partner, could lose more than that. In a partnership, profits are passed through the partner's tax returns. Pass through means that when you have a partnership, so let's think that this is now a partnership, you would have that same P&L statement with the revenue, expenses, and then you would have something in here called EBITDA. EBITDA stands for, my picture is in front of this. 1 second here. EBITDA stands for earnings before income, taxes, depreciation, and amortization. So it's a step before the net income. Depending on the business that you're running, you would have taxes that are not federal or state taxes, because the federal and state taxes, which is the bulk of taxes that you as an individual pay and your business would also pay, are paid through the owners. For example, when I was in New York City, I was working in a company and we would pay something called the UBT tax, which is unincorporated business tax for New York City. That's a city local tax. The business would have that, would incur this expense. And after the business paid the UBT, we would then have the net income of the company. Then the money would be distributed to the partners via a form K1. And a K1 is a tax form that your CPA or your lawyer, whoever is helping you with taxes, would file on your behalf for the partnership, and they would split how much net income or loss belongs to each one of the partners. So let's say you have a partnership, you have 2 people, you each have 50% of the company. Your K1 would say you have 50%, your partner have 50%. Your CPA, or even yourself, if you're filing your taxes, would take this document, and you, as the owner of the partnership, would pay the taxes for the business and yourself, since you're making distributions out of this business. So a partnership is a form of structure that might be chosen for its simplicity and lower costs. It's almost like the sole proprietorship, where it's very easy to set up, but when you have partners. Next, let's talk about a corporation. If you are starting, you'd see that the chances that you would start a corporation are really low, because a corporation is a separate legal entity from its owners, and it's mainly used when you want to scale rapidly, you want to go public, and you want funding. You want people to invest, you want venture capital coming into your business. There are 2 main types of corporation. There is something that is called a C corporation and an S corporation. So a C corporation is taxed separately from its owners and incurs double taxation. This means that, coming back to our P&L example, you would have as a corporation in here, so like this is not a partnership anymore, as a C corp, you'd have your revenue, your expenses, you get to the EBITDA, and here, earnings before interest, taxes, depreciation, and amortization. Here you'd have taxes, and you'd pay, your business would pay taxes. So you pay minus taxes. And once you get to the step that you have your net income, you would distribute this, you'd have distributions to shareholders. Once the money gets to the shareholders, you, me, people who own stock in the business, would pay income taxes as well. And that's why it's called a double taxation. You can also have a S corporation, which is a pass-through taxation, just like we saw on the partnership. And it's limited to 100 shareholders. This is important because in an S corporation, you must pay yourself a salary. So as the owner of the business, you are also an employee of your business. You're paying yourself a salary. The S corporation is paying payroll taxes. You yourself are paying payroll taxes on your salary, and you're also receiving distributions. So it's 2 ways that you're making money out of the business: the salary and the distributions. Many people choose an S corporation status because this is a way that, if done correctly, you can lower the amount of taxable income and self-employment taxes, which we can talk in a separate section. S corps can issue stock. They're limited to 100 shareholders. All shareholders must be U.S. citizens or U.S. residents, and the distributions must be equal the amount of the ownership. This means that if you own 50% of the S corp, you must receive 50% of distributions. You cannot do an uneven distribution where your partner and yourself as 50-50, one would get 60% and you would get 40. That's not a possibility. It's not this flexible. Okay, so now that we covered partnerships and corporations, let's finally go to an LLC, a limited liability company. An LLC is a special type of structure because it is a hybrid. It is the newest type of business structure, and since its introduction, LLCs have been the most popular type of business structure in the United States because of what I'm going to explain now. They provide the limited liability that a corporation would provide. So you are there's a wall between yourself and the entity, and if everything goes sour, no one can go after your personal assets. The losses will stop in the level of the company. And on top of that, it offers the flexibility and tax benefits that a partnership would have. What does that mean exactly? The members don't have the liability, as we said, but you can also choose to be taxed as a sole proprietor, as a partnership, and as a corporation, depending on the stage of the business that you are, depending on what makes sense to you. So this is really great if you are a single member LLC. So let's say you are a single freelancer, but you say, you know what, I don't want to incur all that personal liability. I want to open an LLC. You can open an LLC by yourself. You don't have to have partners to open an LLC. And you can take advantage of the protection of the liability, and you can also choose to be taxed as a sole proprietorship with that same fluidity and the same ease as the taxation of a sole proprietor. You can have a partner, which means that you are a multi-member LLC, by your taxes as a partnership, meaning as a pass-through entity where profits are passed through the partner's personal tax return. And you have the option to be taxed as a C Corp or an S Corp, and founders usually choose to file as an S Corp to lower the amount of self-employment taxes. In that case, as we said, you need to pay yourself a salary, you need to be on payroll, it requires a little bit more work. But in some cases, when you discuss this with your CPA, it might make sense for you to do it and have an LLC with a status of taxation of a S corporation. So if you were starting a business, there's two main options. You're starting this by yourself and you're comfortable with the level of risk that you're taking, and you don't even know if the business is going to work, if it's going to be a venture that you're going to try it out and it might die. Go with a sole proprietorship route. If you have partners, or if you are operating by yourself and you're not comfortable with the risk of having unlimited liability, open an LLC, and then you can choose how you want to be taxed. That's my personal opinion because of the level of simplicity that a sole proprietorship provides to you, and because of the level of flexibility that an LLC would provide to you. Those are the main reasons why I chose those structures to myself. On one side, in my consulting business, I wanted a simplicity. I am okay with the risk that I'm incurring. I am a sole proprietor. In my LLC, in the business that I have partners, one, I had partners from the beginning, so I couldn't go with a sole proprietorship. And two, I enjoy and appreciate the flexibility that we were able to choose if we were going to be taxed as a partnership or a corporation. Hopefully this was helpful. and now you have a little bit more information that you had 20 minutes ago. You can take this information, do more research, or take it to your tax attorney or CPA and show up on that call with a little bit more confidence that you know what you're talking about, and ask for additional explanation, and at the end of the day, make an informed decision for your own business. So, see you next time.